Hello, everyone. Welcome back to another edition of the Week in Charts. Charlie Bilello here, bringing you the most important charts and themes that I'm seeing today in markets and investing. If you're watching this on YouTube, take a moment, hit that subscribe button for more content just like it. A lot of exciting, new, interesting content coming, so make sure you're subscribed to the channel. Okay, before we begin, exciting offer I want to talk about from Creative Planning, my firm, creativeplanning.com/Charlie. Set up a call, set up a meeting with an advisor today, and you'll get a free wealth path analysis where we're going to have a conversation with you, looking at your portfolio, looking at your roadmap to financial independence, making sure you're on the right path, giving you proactive tax strategies, and doing an insurance and estate planning review, making sure all your documents are in order and your assets are protected. So go to creativeplanning.com/Charlie. At Creative Planning, we're in all 50 states, so we likely have a location right near you. Over 300 billion in assets under management and advisement, and we're here to help. creativeplanning.com/Charlie. Okay, what are we going to be discussing today? So much is going on in markets. Huge Fed meeting, of course, last week. We've got to discuss that big rate cut, 50 basis points from the Fed. The easing cycle has officially begun. Number two, I don't know if you've noticed, but everything is up now this year in terms of major asset classes. I'm going to run through that. Number three, is the U.S. consumer pulling back? I've been asking this question for months. We've got more data in terms of retail sales. We're going to look at the U.S. economy, other data points, and try to see where this fits into that. Number four, will lower mortgage rates unfreeze the housing market? I think that's the hope. Obviously, inventory is still low, but some good news, they're rising. Interest rates, of course, are coming down. Is that going to help things? We'll try to answer that question. Number five, the other side of mania. I've often talked about different manias, and they always end in the same way. I'm going to show you that in the latest example here. Number six, we're going to end as we always do with something positive. That's democratizing education. Okay. Number one, the easing cycle has officially begun, and it began in a big way with the Fed cutting rates by 50 basis points. Was this expected? Not so much. If we looked at 10 days before the meeting, I did this poll on X. Most people, 68%, said 25 basis point rate cut. If you asked me at that point in time, I would have said the same 25 basis points because there seemed to be no reason to do a big rate cut at that point. But if we go a day before the meeting, what we saw was very interesting. The odds had shifted in terms of Fed fund futures. They showed that the Fed was now expected to cut rates by 50 basis points. It was about a 60-40 split. And as I often talk about, the Fed always does what the market's expecting it to do the day before the meeting. And the market was saying 50 basis points, and the market was correct. So whether that information was leaked or if the Fed simply looked at what the odds were at that point, they didn't want to disappoint the markets. And so they did 50 basis points. And that's a big cut. We don't often see the Fed start out with that type of cut. We saw it two other times, as I've talked about, in the last 30 years or so. We're looking at September 2007, January 2001. They also did 50 basis point cuts at the start of rate cutting cycles. Of course, both of those situations, not very good for the markets, not very good for the economy. And so the big question today is it the same as those time periods, or is it different? Is the Fed cutting 50 basis points here just because they can, because inflation has been solved and they're being overly restrictive? Or are they doing it because they see something in the economy that's coming that's much worse than people think? And so we don't know the answers to that, but we do know that historically, those 50 basis point rate cuts that a lot of people are excited about today haven't been very good for the markets going forward. If we see what the markets did after that September 2007 cut and January 2001 cut, negative returns looking out a few years. And when the Fed has started smaller with 25 basis point cuts, we tended to see positive returns going forward. Now, that doesn't mean this time, a year from now, the market has to be lower by any means. It means that just because the Fed is cutting rates big, it isn't necessarily bullish. I think every time is different in terms of Fed rate cuts and what the market does going forward. In the Wall Street Journal had an interesting graphic here kind of illustrating that. You can see the path has been different pretty much every single time that the Fed has started a rate cutting cycle here. different shape of the performance here over the next year. Sometimes you start out slow and then you're higher. Sometimes you go down, and sometimes you go down and then up, as we saw after the 2019 example. So no textbook is going to be able to tell you what the market's going to do based on a rate cutting cycle. It isn't necessarily bearish or bullish. If we look historically, as I've talked about, the market tends to go up regardless of where the Fed funds rate is, regardless of whether the Fed is cutting or hiking. It tends to be higher 1 year, 2 years, 3 years out. And there's always exceptions to the rule. And I think the big exceptions here being when the Fed has been forced to, or in their mind, forced to cut interest rates very aggressively, it hasn't been good news for the market because it's been associated with economic downturns where earnings are going down. So that's the big question. Are we going to see a recession? And if we are, and the Fed is very aggressive in cutting interest rates here, that may not be the bullish indicator that people are thinking right now this big rate cut is. But if we look at simply Fed funds rate versus core PCE, the Fed has more room to cut in terms of the way they look at things, because they're saying, well, there's still 2% spread here between the two, and that's being restrictive. And if you think this core PC inflation rate is going to come down over the next year, which the Fed is projecting, well, then you have room to get ahead of that by continuing to cut interest rates. And the US is simply joining the rest of the developed world in terms of cutting. We've talked about Switzerland has already cut interest rates, Denmark, Sweden, the Eurozone, Bank of Canada, Bank of England. The Fed is just joining these other central banks in really moving from a restrictive policy to a easier monetary policy. And the expectation, I would say right now, is pretty aggressive. The Fed's comments, the Fed's dot plots didn't really change that in terms of what markets are expecting. They're still very aggressive in terms of what the market is thinking the Fed is going to do over the next year. They're actually expecting the Fed funds rate to end 2025 below 3%, which would be essentially right at the Fed's long-term target, what they would consider, I guess, a neutral rate for the Fed funds rate by the end of next year. So I think all of that is assuming inflation doesn't tick back up, and the picture in terms of the economy is not so bad, but perhaps the market is saying, in part of this, that the economy is going to get worse, and that's going to lead the Fed to very quickly move back to a neutral stance. I don't think it's going to play out this way. It almost never does. Very much not predictive in terms of long-term looking at what the Fed fund futures were expecting. It's only very predictive in the short run. And what the market's expecting in the short run is 25 basis point cut in November and then 50 in December. That's a little bit more aggressive than what the Fed is thinking, but not much. The Fed is essentially saying 2 more 25 basis point cuts. If we look at their dot plots, the Fed is saying Fed funds rate is going to end the year at 4.4%, but the market's a little bit below that. The interesting thing, if we look at these Fed projections here, is that the Fed's essentially saying they're going to be able to do these cuts over the next year, and they're going to do it not because the economy is falling to recession. So they're saying the unemployment rate is not going to increase next year. It's going to stay at 4.4%. So I guess they think it's going to go up a little bit between now and the end of the year and then kind of stay there. And they think that core inflation essentially has been solved. It's going to continue to move lower and get back down to 2% by 2026 here. But you can see 2.6%, their projection for this year, 2.2%. So essentially, very much a soft landing. And Powell's asked about the recession. Is it coming? Is there a higher risk of it today? And he said essentially he doesn't see anything in the economy that suggests a likelihood of a recession or a downturn is elevated. You see a growth at a solid rate, inflation coming down, the labor market still at solid levels. So he doesn't really see it. So if we take him out of his word, they're doing these cuts because they can, not because they see a recession coming. And if that's indeed the case, then you wouldn't expect them to be doing another 50 basis points or get very quickly down to 3%. You would expect a more moderating pace, I would say, going forward. And that seems to be the expectation right now for November, market's pricing in a higher likelihood of a 25 basis point cut, but way too early to say. Again, this is only predictive, really a few days out, but another cut is certainly coming for the November meeting. It's just a question whether we're going to see 25 or 50 basis points. This is the more interesting question, I think, in terms of the Fed is, are we going to have a little bit more dissension going forward? So we've had a unanimous Fed in terms of everybody moving in one direction in terms of their policy. And finally, we had a dissent here from Michelle Bowman here, who said that a smaller cut was warranted. So this is the first dissent from the Fed since 2005. And I kind of agree with her reasoning, saying that a 50 basis point cut could be interpreted as a premature declaration of a victory over inflation. I think that is kind of what they're saying and may unnecessarily stoke demand. And she's also pointing out that inflation isn't at the 2% goal yet. We're still at 2.5%. We haven't achieved the goal. So I would very much agree with her. If I was on the Fed, I would say no cut. I would dissent and say no cut. But this is interesting because I think that there should be some dissension in the rate. How is it likely to have all of these individuals always agreeing 100% in terms of should we cut, should we hike? That doesn't make much sense to me at all. So I think there should be more debate and more pushback within the meeting, and not just agreeing with what the chair is kind of saying here. So we'll see if that's the case going forward, and we see a little bit more debate on how quickly the Fed funds rate should be pushed down. But the overall point in terms of 2%, and it wasn't addressed in this meeting, it's never addressed, no one ever asked this question. They keep on saying we're getting back to our 2% target, but that's only the target of, if you look at just the last year of inflation. It ignores the above average inflation that we've seen since the beginning of 2020. And I don't think there's any world where you should ignore that. A 2% inflation target should be looking at the cumulative rate, the long-term average rate of inflation, not just simply the last year. But that's not the way the Fed seems to look at it. It seems like they just erase the memory of high inflation as soon as you get back down to that 2% level. And this is a real fascinating question here, but I think it's actually a good one for the Fed to discuss and debate. Essentially saying, are we going back to that ultra easy monetary policy that we saw since the financial crisis in 2008, when we held interest rates at 0% for 7 years before very gradually hiking interest rates? And Powell had this say, he said, we're probably not going back to the era where there's trillions of dollars of sovereign bonds trading at negative rates. And his own sense is that we're not going back to that. But honestly, we're going to find out. And I don't really know what that means. It probably means if there's a recession coming and they feel the need to go back to an ultra easy stance, perhaps they'll do it. But I think this is the more important point here, is that he's saying the neutral rate is probably higher than it used to be, but how high, he just doesn't know. And that's ultimately the right answer, but it should give everyone pause, because they don't know where the neutral rate is. No one knows. The market knows. And this idea that 12 people can figure out this perfect interest rate that's going to prevent recessions and keep inflation in check, that for a $26 trillion economy, well, that's impossible. The Fed cannot get it right, because no human being could get it right. The market should be determining it. But that would be a big change, I would say, if the neutral rate is higher than it used to be. For this entire period here, almost, you had the Fed funds rate below the core rate of inflation. So ultra easy monetary policy, something we had never seen in history. And now he's saying we're probably not going to that point, back to that point again, which would mean a Fed funds rate a little bit above the inflation rate. That seems to be their target, at least for right now. Their long run projection for Fed funds rate 2.9%, and their projection for core inflation 2%. So if that's indeed the case, then we have a very different monetary policy regime than we had all of those years from after the financial crisis. So of course, no one knows if that's going to happen, but interesting to hear Powell say that perhaps things have changed. We're not going back to that regime. Of course, the Fed can control that very much so. The question is, will they? Are they going to go back if there's another crisis or another economic downturn? Are they going to go back to zero, or are they going to have a higher neutral rate? We'll see what happens. No one knows the answer to that right now. Okay, number two, everything is up. If we look at the financial markets, S&P 500 exploding higher the day after the big rate cut, hitting a new all-time high. That was the 39th all-time high of the year for the S&P 500. Just been an incredible run this year. You could see we had a few pullbacks. So March to April, around 6%, July and August, 10%, but market moving past both of those situations, another all-time high, 39, and you can just see this run since 2013 here of all-time highs. We've never seen anything like it over this period of time. Even during the 1990s run, we didn't see as many all-time highs as we've seen since the beginning of 2013. So just an incredible run. Of course, we did have that 23 drought, 2023 drought because of the 2022 bear market, but now we're back in a big way. 39 all-time highs this year, and it's been one of the strongest starts to a year in history. I've showed this chart a lot this year because it's been a pretty steady uptrend with the exception of those two pullbacks. And you can see here 19.6% through 182 trading days. Very much an abnormal kind of return for this period of time. Not unprecedented, but very much abnormal in terms of seeing this strong of a market without an enormous pullback along the way. And what we've seen in terms of milestones, many 100-point milestones for the S&P 500. You can see in January of this year, 4,900, then it crosses 5,000, up and up and up. We just crossed 5,700 for the first time after that Fed meeting. And this is a big differential from what most people were expecting here from the Fed. You can see average year-end projection from Wall Street strategists, 4,800 for the S&P 500. We're at 5,700 right now, 300 points higher than the highest Wall Street target. So very much underestimated what the S&P was going to do this year in terms of these expectations from Wall Street strategists. And if we look at other asset classes, we look at gold, 27% this year, hitting all-time highs again. Of course, gold very much boosted by real interest rates falling, as we've been talking about, and they continue to fall if we look at inflation-adjusted yields. And see the S&P 500 with dividends up around 21%, REITs 14%, and bonds around 5% return this year with interest rates falling. So across the board, everything higher now. 100% of major asset classes higher in 2024. We haven't seen that since 2019, which is, of course, very strong year. And what a difference this year and last year have been following that 2022 downturn where stocks and bonds fell together. Now everything rising, and we're just seeing very strong returns kind of across the board here in all major asset classes. Okay, number three, this is the big question. Is the U.S. consumer pulling back? And it's big because the U.S. consumer drives the U.S. economy. And for the most part, what we're seeing is a pullback, but not an enormous pullback. It's just been very steady here in terms of retail sales, in terms of slower growth rates. So if we look at retail sales year over year, up 2% over the past year. That compares to a historical average around 4.6%, so below average nominal growth. But if you adjust for higher prices, you adjust for inflation, what we're seeing, the picture is a little bit worse here, down 50 basis points. And you can see here, we've been below zero a lot over the past 2 years. So quantities going down, and certainly that seems to be an indication that consumers, the cumulative effect of inflation is having an impact on consumers, and that higher interest rates are having an impact as well. Anything that's financed, obviously higher credit card rates, higher auto loan rates, anything that's financed, we're seeing a lower rate of purchases in terms of those things because it's harder to afford them with the interest rate being higher. And I think this is an important chart to look at because typically when consumers are stretched, they save less. And we're definitely seeing that in terms of the savings rate here, 2.9%, and historical average around since the mid 1990s around 5.8%. And this is the lowest since June 2022 when we had inflation at 9%. Before that, you got to go back to the mid 2000s. So surprising to see the savings rate this low with inflation coming down, with the jobs market still doing pretty well. We're not seeing mass layoffs yet, as we'll talk about later. But U.S. savings rate going down and people spending less in terms of retail sales is something definitely to watch. And then you have leading economic indicators moving down again for a few months. The conference board was saying no recession. The warning is over. As we've talked about, they've gotten it wrong many times over the past few years. They were thinking a recession was going to begin in 2023 all year, and then they crossed it off. And now I guess it's triggering a recession signal again here in terms of their leading indicator composite. And one of those leading indicators would be, of course, the yield curve, which if you look at short-term interest rates is still inverted here. But as we've talked about, the 10-year and 2-year spread is back in positive territory. It's actually steepening now with that 2-year yield moving way down. And the 10-year, interestingly, the 10-year yield actually moved up a little bit after the Fed interest rate cut. So what has happened historically when the spread has moved back into positive territory, the 10-2 spread, we've seen a recession. And that recession, if we're looking at 1989, didn't begin until 13 months later. So in 1990, in the summer of 1990. But different lags or leads between this data, but the consistent theme over the past 5 examples we have here is an economic downturn. So when are we going to see it? We don't know. Every time is different. Maybe this time we avoid a recession altogether. But if you take this data with the unemployment rate going up, with the downturn in the housing market, with a number of other indicators like retail sales that we're seeing, it's starting to build in terms of we're seeing all these indicators. And now we have the Fed cutting interest rates, and they say they're not cutting because of economic weakness, but it is part of it, right? So the fact that the unemployment rate is higher, that we're seeing fewer job openings, if they are talking about that. So it is part of it that they're worried about a slowdown. They just don't see a recession here and now. Now, in terms of, this is going to be an interesting thing to watch because the Fed very much controls this dark blue line. So the 3-month Treasury rate, the Fed has complete control over that. And so when interest rates go down, they cut interest rates 50 basis, but this is going down. And the expectation is Fed's going to continue to cut rates in the next few months. So this is going to continue to trend lower. So when is this spread between 3-month and 10-year going to turn positive? I would say likely at some point in the next 3 or 4 months, if the Fed does what they're suggesting. The question will be, where is that 10-year going to settle in at? And that very much depends on the expectations for longer term growth and inflation in the US. So it's not a guarantee that the 10-year yield is going to go significantly lower unless we see much lower inflation expectations, much lower growth expectations for the looking out 10 years from now. So that'll be something I'm watching closely. And the other thing would be, in terms of the jobs market, initial jobless claims have to be the thing that you're looking at most closely because they're the best leading indicator for the jobs market. And we're just not seeing a spike in this yet, which you tend to see during recessions. So when you have an outright recession, you're going to see layoffs. You're going to see more people filing for unemployment. And we saw it trending up until August, but since then, it's been moving in the opposite direction, moving down. So that's not something you typically see during a recession. So yes, we have the unemployment rate rising, but so far it's not because we're seeing massive layoffs. And that would be the concerning thing that tips you over into, let's say, the odds of a recession are really rising here. You're going to see this trending up. It's actually lower than it was a year ago. So watching that definitely very closely in the weeks to come. Okay, number 4, will lower mortgage rates unfreeze the housing market? This is the big question because the housing market still frozen here. We got new data, existing home sales down 4% over the last year. That was the 36th consecutive month of negative year-over-year growth for existing home sales. And you could just see it in the picture here. That was the longest. This is the longest downturn we've seen for sales activity since the financial crisis, since the last housing bubble burst. You could see here existing home sales almost at the lowest levels we've seen. You have to go back to 2010, below the COVID lows, even when everything was shut down and nobody was transacting. And the biggest reason for this is, of course, the lack of supply and the lack of affordability. So prices still elevated, still up 3% over the last year, although you can see the trend seems to be moving down. So the pace of increase in terms of prices definitely moderating here, and I would expect it to continue to moderate. But this is the big factor, right? Prices exploded higher 2020, 2021, largely because of what the Fed did in terms of printing money, in terms of buying mortgage bonds and driving that rate below 3%. And you could see here, still elevated, although not higher than where we were 2 years ago in terms of the median sales price. And so what we need in the housing market to normalize things is more inventory, more supply, and we're slowly but surely seeing that. So here, existing home sales month supply 4.2. So still not enough, I would say, to lead to price declines, but we're moving in that direction in terms of the average is around 5 months supply. So if we get to 5-6 months supply, I think you're going to see a real moderation in terms of the rate of increase. I think you're going to see more activity in the housing market. And the big question is, how much are lower mortgage rates going to lead to more people listing their houses for sale? So far, we've seen an increase. It just hasn't been a huge increase. So mortgage rates are now down to 6.09% and tied for the lowest level we've seen in a few years. Obviously come down significantly from the peak last year. And is this changing the situation in the housing market? A little bit. So if we look at the active listings of homes for sale here, 16% year over year increase, but still definitely below where we were pre-pandemic levels. So still very low inventory in most places around the country. So the question is, how much lower does it have to go to really stimulate people listing? And it all comes down to affordability. So it depends on, can that person who wants to move, who wants to upgrade, buy a bigger home, whatever they want us to move locations, can they afford that new home based on that mortgage rate? And at 6%, it's still unfortunately very much unaffordable. So I don't know how much that changes things. It probably has to go lower to stimulate things, but we're moving in the right direction. And I suspect that this will continue to normalize, continue to trend higher, because as I talked about, I think 2 weeks ago, sooner or later, people have to move. So it's whether they have a change in their job or they're retiring, any number of factors, sooner or later, more people will be in this camp where they have to move. And many of these people are no longer dependent on interest rates to move, because they no longer have a mortgage. And if that's the case, then it's just a question of, do I want to list now? But no question, that lock-in effect is big and it's real. And we don't know the point where it's going to start moving up, maybe 5.5%, maybe 5%. Some people have suggested lower. But at a certain point, I think you're going to see a big increase in terms of the number of listings, and that will really moderate the pace of home price growth. And maybe we're going to see declines, because home price is very much unaffordable based on people's incomes, and that's not something that's sustainable long term. So very much what I think in the next 10 years is you're going to see much lower rate of appreciation for home prices, and you'll probably see negative real growth for home prices over the next decade in terms of home prices not going up as much as the inflation rate over the next decade. Okay, very quickly here, I want to talk about the other side of Mania. People are asking me an update on Trump media. I talked about this a few months ago when it was going crazy after it listed. and it just spiked to this crazy valuation. It was actually valued at over 10 billion, which was kind of insane because it's a company that had sales of less than a million and maybe a million active users on the Truth Social app. So it was kind of a crazy situation because you had Reddit going public at a similar time, and Reddit has way more revenues and way more active users, and it's trading at a similar valuation as Trump Media. So what we said at the time is this is just a good old-fashioned mania and not likely to persist unless the fundamentals just were to go crazy to the upside, where all of a sudden it's seeing way more revenue, it's starting to make money. That hasn't been the case, of course. And what we've seen, the other side of Mania is the weighing machine where fundamentals actually matter. And the stock at this point is down 84% from its peak. I would still say that it's kind of extreme because it's still trading at over 400 times sales. What are those sales? Less than a million in the most recent quarter. It's trading at 437 times sales. So it still has a market cap of $2.5 billion, which is kind of incredible for a company with less than a million in quarterly sales. So could this go lower? Yeah, it definitely could. And just a lesson for investors is it rarely pays to buy into a speculative mania. Eventually, the weighing machine is going to set in. Okay, I want to end as I always do with something positive, and that would be democratizing education. We all know the cost of education has skyrocketed. It's gone up way more than the rate of inflation over the past 30 years. And things like affording a tutor or affording test prep has gone up as well. And there's increasing products in the technology world that should be able to disrupt that and should be able to help with that. And the latest, of course, is AI. AI in the classroom can hopefully democratize education, make it more accessible, make a high quality education and learning much cheaper, much more affordable, really affordable for anyone. I've talked about Khan Academy in the past. I use it with my own kids if they're having trouble in math or a science subject. Go on Khan Academy. You can learn it there. You can watch these great videos. You can do test questions and so much more for free, 100% free. How great is that? You can get pretty much any course in math and science and more. And now they have this new AI powered tutor, $4 a month. I don't know how good it is, but the fact that there's a tutor for $4 a month when you're talking about tutors charging, at least where I am in New York, $100 an hour or more, that's amazing to me. So this is something that I think is going to be huge in the future for students, for teachers, for parents, using AI to make things better, customized for the student. They have a problem, they can ask this AI powered tutoring app a question, a specific question. It's going to be able to tailor it to you. It's going to see the way you're performing on quizzes and tests and hopefully help you become a better student. And it doesn't mean you don't have to do the work. It's just going to give you access to someone who can help you understand it better. I think that's an amazing thing. So it's one positive. We know there are negatives to AI, but one, I think, big positive is going to be disrupting education and really helping people access the best information and the best way to learn in a customized way. And of course, much, much cheaper than the existing regime. So huge positive, I think, over time for education. And we'll end it right there. Thank you, everyone, for joining me this week on the Week in Charts. Have a great week. If you're watching this on YouTube, hit that subscribe button for more content just like it, and I'll see you next time on the Week in Charts.